Roland, thank you very much for that, and good evening, everybody, and thank you in advance for listening to what I hope will be a fairly brief sort of presentation, and then we'll move into to Q&A at the end. So, my name is Dorian. I'm the CEO at Belvoir. As the slideshow clicks through, so past this, thank you. So, brief introduction. Dorian, CEO at Belvoir. I've been CEO twice in the last 10 years, slightly confusing, but I was CEO in 2010, saw us through the float in 2012, had a break from 2014 to 16, and then became CEO in 2017 to the present date. Louise is also with me. She's very skilled CFO. I think the way we're going to do this between us is that I'll run through the presentation, which is fairly brief, and then Louise will jump in at the end if there are any sort of financial questions, or if you've got any specific questions for Louise. Just at the bottom of that slide, before we sort of move into the 2 or 3 slides that we've got, beneath myself and Louise, we have another board. So we have the PLC board, which is 5 strong, and then we have a separate board underneath that, which we call our operations board. We don't really talk too much about the operations board in these presentations, but there's sort of an expanded view of the people in our business within our annual report, which is downloadable. But we just want to sort of stress that in addition to Louise and myself, we've got 10 people across 2 boards. Interestingly, 26 years of sector experience per person, so that's the average sector experience, and 9 years experience with, well, 9 years service with the Belvoir Group itself. So that's just a brief intro. Okay, so what are we? What are we and what do we do? Well, I mean, firstly, we are the UK's largest property franchise group. We've got 396 individual businesses across 5 brands, and if you're familiar with how franchising works, franchising joins a franchise business, whether it's our business or Domino's or McDonald's. There are lots of high quality franchise businesses in the UK, and they pay the franchisor to use their system, access their website, access training, all aspects of support. So really a franchisor provides the entire system, the franchisee operates that system within the confines of that franchise, and in essence build their own business. And across the 4 brands at the top, which I'll explain what each brand does. So first off, we've got Belvoir on the in the top corner. So we listed as Belvoir in 2012. Back in 2012, we didn't have Newton Fallowell or Northwood or Lavelle. It was specifically a Belvoir brand, and we're listed as a residential lettings specialist. So if you're a landlord or if you've been a tenant and you've rented through an agency, we are one of those agency chains. But the difference in our business model compared with the majority of the larger chains in the UK is that we have a franchisee at the heart of every one of these businesses. Their business means the world to them. They're very growth orientated, and as you'll see from our H1 results, when you've got a franchisee at the heart of a small business, these businesses are immensely resilient, immensely creative, and really sort of a joy to be part of. And I'll show you the results in H1 that showed our resilience during the lockdown for a start. So Belvoir was the original brand. We then, back in 2015, embarked on a multi-brand strategy. We decided that we wanted to get involved with estate agency, as in property sales, and we needed to buy in some skill, estate agency skill, and we did that by acquiring Newton Fallowell. If you're in the south, you've probably never heard of Newton Fallowell. It's based in the very strong agency group in the East Midlands, and that was our first sort of foray into estate agency. 2016, we acquired Northwood. Northwood is very similar to Belvoir in that it's very much a residential letting specialist agency chain, 88 offices up and down the country. And then at the beginning of this year, basically the timing, probably when we look back as a management team at our timing of the completion of this deal, it probably wasn't ideal, but it's come good. We acquired Lavelle Estate Agency, again a provincial sort of eastern East Midlands estate agency network, very strong in the areas which it operates. We completed on that deal in January, and which took us up to 396 businesses across 5 brands. The brand that's missing, sort of below the line, is that 3 years ago we identified an opportunity in our business, and that's clients want access to a mortgage advisor, so our landlords, tenants in some cases, buyers, sellers, they want and need access to a mortgage advisor. And we decided to embark on this strategy to help offer additional services to clients, and more importantly, to help our franchisees with another business opportunity whereby they can have a mortgage advisor sitting in their branch, writing business on their behalf. Now, the brand that we've chosen to operate as is Mortgage Advice Bureau. That's another AIM listed business. Some of you may invest in that. We're obviously separate to Mortgage Advice Bureau, and the easiest way to explain our relationship is that we've got 174 mortgage advisors working in a variety of locations. These are our mortgage advisors, but we choose to process our business and to partner with Mortgage Advice Bureau, who in turn for the business from our network, they provide us with a system, compliance, training, almost like a sort of franchise arrangement in a sort of way. But Mortgage Advice Bureau, brilliant company. We partnered with them with their largest account with 174 advisors, and we've grown the mortgage advisor side. This is one of our areas of organic growth over the next year and 2 years. We've grown our advice base by 38 mortgage advisors organically in the last 12 months. This is one area of growth for us. Later in the presentation, I'll show you a map of where our offices are. We need to recruit a further 75 to 100 mortgage advisors to adequately cover our footprint of estate and letting agency offices. But again, as I say, that's one area of sort of key growth for us. Across the 4 estate agency and lettings brands, Belvoir and Northwood are primarily residential lettings, so 90% of the revenue generated by franchisees in Belvoir and Northwood is from residential lettings and management of properties. Newton Fallowell and Lavelle, it's the other way around. They're very strong estate agents, and it's their income is 75% estate agency, about 25% residential lettings. And if you push financial services to one side, across our whole network, the revenue split between residential lettings, which is recurring, so even if you close these offices for 2 months or 3 months for a lockdown, and we've been through this at the start of the year, that revenue continues to flow through the business. That's what underpins us. And 80% of the revenue across these 4 estate agency and lettings brands is from residential lettings, 20% is estate agency, which is probably a good point to move into the next slide. So what happened in H1? Well, just some general highlights for you. In the slide deck, we have there's a section, if you've got a copy of it handy, there's a section, the financial highlights in the middle, and at the end there's a section on the market, which is always quite a big conversation whenever we're talking to investors or potential investors. General highlights of H1. I mean, first off, our market cap has sort of risen to 56 million. We've had 23 years, so up until the start of this year, we had 23 years of unbroken profit and turnover growth. We're profitable, we pay a dividend, and then of course we entered 2020 with the challenges that H1 brought. We've had a very good H1, better than expectations, and I'll whiz through some of the highlights. So revenue of 8% to 9.8 million. Of which 2% relates to the underlying business, so like for like, 6% to the acquired Lavelle network. We've split that out just so an acquisition doesn't mask the underlying performance, which on the basis that our network was forced to close for around 2 months is just an incredible result. Profit before tax up 17%, EPS up, cash generated up 29% to 3.1 million. And our performance in H1, despite the lockdown and the requirement for all of our retail units to close temporarily, was in line with our pre-COVID management expectations. And we sort of gone further than that. And looking forward to the full year, we expect our performance to be in line again with our pre-COVID management expectations, so good performance all around. I mentioned earlier on the financial advisor network at 38 to 174, and that's from organic growth. One question that investors always ask me, because we're a strong residential lettings business and 80% of our revenue is coming from that side of the sector, a key question is, can tenants pay their rent during a difficult period? Will tenants pay during a lockdown? Our rent arrears survey shows that less than 4% of our tenants are currently in arrears. Normally it's around 2%, and all agency networks have a level of arrears. It's just unavoidable in a business that manages properties and collects rents. But ultimately our arrears are very low, and that's the same across pretty much all estate agency and lettings networks. Some landlords who don't use an agent are reporting higher arrears, but that's a different space to the space that we operate in. So we also see no increase in arrears of monies due from franchisees as a result of the lockdown, and we haven't lost a franchisee because of the lockdown or challenges, not one, and we haven't lost a franchisee for either reason, either health reasons or business reasons. So our network emerged from the lockdown exactly the same strong position as we entered the lockdown. We announced a strategic alliance with the Nottingham Building Society in July 2020. There is an RNS on this if you want to read any full detail. But in a nutshell, it's an arrangement whereby, and you'll see this coming through in H2, we have the opportunity to occupy some of Nottingham Building Society's branches and put a lettings and estate agency module within these branches. Quite an exciting relationship for us. It's been sort of a year in discussion, and as I say, that there is more detail within an RNS. We've also reinstated our dividend policy. So for the first time in our sort of history of being listed, we suspended the dividend back in March while we sort of evaluated where the business would be as a result of the lockdown. We've met our expectations in H1, so we've reinstated dividend, and then we've announced a catch-up of half of the sort of suspended dividend. We're going to take a view on the other half in March next year, when we have a sort of view on what our world looks like at that point. But due to sort of prevailing market conditions, the market is very, very active at the minute. Stamp duty cut, pent-up demand as a result of the lockdown, that we do expect our world to actually be slightly better in March next year than it is now. I'll move on to the next one. So just a general sort of summary of why invest in the business model. Well, we are passionate about franchising. We're good at it. We've done it for a very long time, and franchising done well, in my opinion, it is a win-win setup for both the franchisor and the franchisee. Franchisees are far more motivated in comparison with a branch manager, because they've got 100% skin in the game and they want to continue to grow every year. That's the main reason that we've managed to grow for the last 23 years, and we haven't had a break in that, and that's simply down to the motivation and enthusiasm and commitment of our franchisees. And we've got a lean, flexible structure in terms of our cost base. So just before the lockdown, we flexed our cost base, we reduced costs, went into the lockdown leaner than we started the year, and that stood us in good stead, and you can see that in our H1 performance. I mentioned a few minutes ago that the market is very active. So all estate agency chains are reporting a lot of activity in the sector. There's distortion in the market at the moment that started a few weeks ago due to an announced stamp duty cut. And normally what happens when a tax change is going to kick in, or tax is going to increase. So stamp duty is being cut for a period up to £500,000. It comes back in March next year. So you'll see a sort of race to get transactions completed before March, which just distorts the number of transactions. Not that we're complaining, we'll make the most of what we're seeing as a very active market at the moment. Our pipelines of sold properties and also financial services, which sort of sits hand in glove with a strong estate agency market. We're expecting a good performance on both sides, estate agency and financial services in H2. Bank balance 5.9 million as of 16th of September. I mentioned our recurring revenue, and one question again we normally ask very early on is what percentage of our gross profit is derived from recurring lettings income, and it's 62%. This time last year it was 63%. It's there or thereabouts, and that was taken into account. We had a lockdown for 2 months. Highly cash generative, operating cash conversion of 95%. I mentioned that had 23 years of unbroken profit and EPS growing. EPS has more than doubled in the last 4 years. I think one thing that the sort of H1 of the lockdown has absolutely demonstrated is our resilience to all franchisees' resilience to handle whatever difficulties the market throws at them. We traded successfully through the last property crash, which is 2007. Interestingly, the letting side of the business normally performs very well when property sales takes a dip, as it did in 2007, 8, 9 and 10, and we listed on the back of the financial crisis. I'm not saying that property prices will fall at some point, but you know there's a chance that may happen next year. Certainly immediately after the stamp duty cut, prices normally sort of level off after a tax change. And then looking forward, as I say, we've reinstated our progressive dividend policy. We also help our franchisees to acquire small agents, and we've helped franchisees acquire about 100 of these businesses in the last 5 years. You can see that we've also grown by acquisition, so we're a team that's acquisition hungry. And just to cap that off, really, the board is confident of meeting its sort of full year pre-COVID expectations. Now, there's a little asterisk just underneath that. So this year, because of the lockdown and pandemic, there have been sort of 3 sets of analyst figures out there issued by FinCap. So firstly, we had pre-pandemic, that was the figures back in January. Then we had during pandemic, which also those figures were changed to reflect the challenges in the market, and then sort of post-lockdown, FinCap's latest set of figures. So 3 sets of figures which you've got access to via FinCap, and there is a link in this presentation to those figures. When we say we're confident of meeting our pre-COVID expectations, that means the figures that we or FinCap issued in January this year, before the lockdown was announced. So stunning sort of H1 for the business in general. I think, Roland, that I've whizzed through, so we can get some questions in. But Roland, if you're ready,
I'm ready. Lovely. Thank you very much. Thank you, Dorian. Okay, we've got quite a few here. I think it's interesting that a lot of people, almost like a bellwether for what's happening in society, is what you see in your business. And there's a lot of questions around kind of bigger trends, I guess. One being about the move of people out of city into the suburbs or into the regions. Do you see that happening? Is that real? And if so, how are you poised to benefit from that?
Yeah, I mean, it's interesting. I think statistically, that hasn't yet shown itself, and it can't, because it takes 2 to 3 months, or actually it's more like 3 months for a property sale to complete. So you sort of view a property in January. In theory, that will complete in sort of March, or at worst in April. My point being that if behaviour's changed as a result of the lockdown, and I suspect it has, and we're seeing that it has, the completions that are happening as a result of this pent-up demand or a change in behaviour haven't actually happened yet. That they're in pipelines, and these sales will start to complete September, October, November, and our pipelines are bigger than we ever expected that they would be. And that's, there are 2 reasons for that. One is the pent-up demand. Second is the stamp duty cut, which will sort of squash transactions into a period. So my point being that I'm saying this anecdotally, that yes, we have seen behavioural change. That people are less willing to travel, less willing to commute. That will have an impact on city centres. I suspect it will have a fair impact on London. 93% of our revenue is outside of the M25. So we started in Grantham. I'm now sitting in Lincoln doing this presentation. You know, we have excellent coverage outside of London, but we're not exposed to the London market as such. It's only a relatively small part of our revenue.
Okay, and next is about acquisitions. There's two parts to this. You've got the 4 brands there. Would there be any argument or rationale to consolidate? And then the second part is, given the buoyant market at the moment, is there a danger that any future acquisition targets may be overpriced?
Yeah, good question. So there's 2 there. You might have to remind me on the second if I get carried away on the sort of first one. So no, I mean, we're not going to consolidate our own brands. So we won't allow a franchisee of Newton Fallowell to knock on the door of a Belvoir franchise and make them an offer with a view to closing that Belvoir franchise and incorporating it into their Newton Fallowell business. We won't let that happen for a lot of reasons, but you know, one of the reasons is that our model is based on having a franchisee with a brand, with a passion to grow that business in a local town. It doesn't matter whether we have 3 or 4 brands operating in the same town. We don't have that many towns where we've got a number of franchisees in each brand. But you know, I mentioned Lincoln a few minutes ago. In Lincoln, we have all 4 brands operating. You know, before we acquired these businesses, they were competing with each other. After we acquired them, they compete with each other. And I say compete with a small c, you know, we are all one network. We're up against, in Lincoln, let's say, you know, another 100 agents. So, you know, it's sort of us against the world in general. And actually, I see it happening in a different way, in that the stronger our business becomes, the more we'll be able to assist our franchisees to acquire competitors that will then be sort of subsumed into these franchise brands, not the other way around. So hopefully that makes sense. And remind me of the second question, just to make sure I don't miss anything.
Dorian, there's another aspect to the consolidation though, is because each franchise has an exclusive territory. So, for example, in Lincoln, Belvoir is operating exclusive territory. So we couldn't consolidate all those brands into one brand and only operate one brand, because we've got several franchisees who all have exclusive territory in that area, don't we?
Yeah, really good point. No, it's that is correct. So, you know, actually, we see Belvoir as a brand growing. We see Newton Fallowell as a brand growing, and we see Northwood growing, you know, and so on and so forth. I mean, across the whole of the sector, there are around 20,000 individual letting and estate agency units. You know, we're growing with 400 offices. You know, we're now significant. But actually, a lot of these businesses, the independent businesses, are single operators. Some of them are looking to retire. Some will exit the sector for other reasons. And we've set up a sort of vehicle whereby our franchisees can buy these businesses, close them down, and bring them into their own franchise. So hopefully that does make sense. And the multiple, which is the second question, is an interesting one. I mean, there are 2 versions of acquisitions for us. So one version is where we help a franchisee to acquire in their town. It's very profitable for the franchisee. They buy a small competitor, close it down, port over the book of business, and it's highly profitable for the franchisee, also profitable for us. And then you've got the corporate acquisitions that, again, we've acquired every year. You know, if you look back through our history, we either acquire once or twice during a year. There are opportunities on that side too, and we remain, you know, very, very acquisitive. I don't think the multiples will necessarily go up for any reason. Not that I can see. I think that businesses like us, if anything, we're good at these acquisitions. The buyers know where they stand with us. There aren't that many buyers actually, you know, who stand in sort of competition with us. But yeah, I suspect multiples will stay around the same.
Okay. Do you have any debt, and how do you service that, if so?
Yeah.
Yes, we do. We have 10 million pounds of debt, and although currently our net debt is down about 4.5 million, and it's payable at half-yearly tranches of £445,000 each half year, and we've got a final balloon payment of 7.9 million in March 2023. But as you can see from this first half, we're pretty cash generative, and we're not high leveraged in any way. and the interest rate is about 1.95 over LIBOR, so fairly good rate for us.
And final question. Yeah, let's read this one here. Where do you see future growth coming from within the business? More letting, estate agents, or mortgages, I guess, which is the largest or the fastest growing area? And then with that, any other financial services alongside the mortgage advice? That's kind of the next obvious thing to add in.
Yeah, so no, good question. That one. There's lots of facets to that one. So, I mean, first off, in the immediate term, H2 and then Q1 next year, you will see the benefit of a very active market across both estate agency and financial services. We've seen this already. We haven't seen any upside yet in terms of revenue because we couldn't have done. These deals are now in a pipeline. They'll start to complete sort of this month and beyond. So H2 will see that benefit. In terms of the stamp duty cut, what I've said to our main investors is that actually I felt it probably wasn't needed at that time because we came out of the lockdown. You had a huge amount of pent-up demand on both the sales and the letting side. The lettings demand has sort of washed through because you can view a property on a Monday. If you're a tenant, view on a Monday, move in on a Friday. It's all very quick. But on the sales side, as I say, it's about 3 months. So immediate term, H2 and sort of Q1, definite estate agency and FS growth for obvious reasons. For a very active market. Going forward, financial services. As I say, we need about 250 mortgage advisors to cover the map that you can see on the screen. And because we grew that. We brought the expertise in to grow financial services. We brought it in by means of acquisition. We brought some brilliant people on board, but by the nature of an acquisition, the people involved so a lot of our mortgage advisors are actually in Yorkshire and they're in the southwest, whereas our property network, covers most of the UK. So we've got a lot of infilling to do, and I suspect that when if unemployment starts to rise, which it is, I suspect that more mortgage advisors will be attracted to our model because in essence it's a self-employed, almost a franchise model if you like. And in the same way, franchising generally performs quite well in a market where unemployment is sort of rising because franchising offers a sort of a way for someone to earn a good living and build a business. It's not a job, but it's not true self-employment on your own. It's sort of somewhere in the middle. So franchising normally performs quite well. So other growth, I mean, I think that we'll probably part in the estate agency. The split is sort of 80% residential lettings, 20% estate agency, and then we've got financial services on top of that. Investors always say to me, Dorian, will that 80%, because that's the recurring element, will that kind of change over time? And it hasn't changed. The split hasn't changed over the last 5 years. We're just growing both sides of the business, one by acquisition, which is the letting side, and the other side sort of organically by bringing in new services. I mean, there are other services that we could offer through our franchise network because the principle is, we've got a 400 strong network, we've got people, we've got experts on the ground in all of these areas. Our franchisees have got shops. On average, each franchisee is turning over about £300,000 a year. These are quite significant small businesses. They're not bedroom-run businesses. So we can offer, a variety of services through that network, through that footprint. As long as they're complementary in terms of our overall model.